Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains. And today we're taking a look at a few strong buy rank stocks to consider to help boost your portfolio as we start the second quarter and then finish off 2022. But before we get into everything, remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into these two strong buy Zacks stocks to consider adding to start the second quarter, I quickly just want to go over the broader market to give a better sense of why these two stocks in particular might be worth considering, and then just give more context for what's going on. So the first quarter of 2022 is obviously officially behind us, and it was chock full of twists and turns. This was fueled by soaring inflation, a Russian invasion, rising interest rates, some subdued fourth quarter or guidance that companies provided in the fourth quarter. The S&P 500 posted its biggest quarterly decline since the start of 2020 in the first quarter, closing the first quarter down 5%. But that said, things looked way worse only several weeks ago. So the S&P 500 surged back above its 200-day moving average. It's down only around 6% off its highs after falling into correction territory multiple times in the first quarter. Meanwhile, the NASDAQ ripped off about a 15% run after falling into bear market levels around the middle of the month, with it currently trading around 11% below its November peaks after it climbed once again on Monday. Obviously, some selling could continue or return, however you want to look at it, and the next three quarters could certainly remain volatile, given all the very real factors tugging at economic growth and earnings multiples. And what's next on the Ukraine front remains really difficult to gauge, and it's really cleared on how this will end at the moment. And inflation hopefully will start to come down from its 40-year highs, but it's going to be more difficult, even though the Fed's raising its interest rates, just because of the ongoing supply chain setbacks, and China's shutting down major cities again because of COVID. So that could have ripple effects sooner than later, or even farther down the road, in terms of just how much of economic activity and certainly global supply chains are based in China. What investors can count on, though, amid all of this difficulty in the markets and the broader economy, is that it's really difficult to call a bottom in the market. And the first quarter in the last 2 years have provided really ample examples why, if you can handle the risk and you're a longer-term investor, why it's always a relatively prudent idea to stay as exposed as possible to the markets, because you can miss some of the big comebacks before you even know it. So if you can handle that downside risk, you shouldn't really be afraid of buying strong stocks right now if you're planning on then holding them for years and years to come. And we should also remember that interest rates appear poised to continue to remain rather accommodating to stocks, even though the Fed funds rate is officially off those rock bottom levels. The 10-year U.S. Treasury is obviously well above its historic and COVID lows of around 0.6%, but at around 2.4%. We're at only around 3-year highs, and we're way below historic levels. And anything pre-financial crisis looks insanely high compared to 2.4%. So this rising rate environment doesn't necessarily obviously support these sky-high valuations that some of the growth companies had early on in the COVID comeback, but the market's already hammered countless of those names. If we look at Cathie Wood's ARK ETF, so that ARKK, her main investment fund, it's still been hammered, and it's really not even come back amid the broader market comeback over the last several weeks. So the huge growth companies are still being hammered, and they're taking into account this interest rate environment more. But if you're looking at stocks that are posting strong earnings already, paying dividends, things like that, these 2.4% yields aren't necessarily going to prevent those stocks from doing well, especially when we consider that Wall Street's going to have a hard time outpacing 8% inflation really anywhere but in the stock market. So with that all in mind, we're going to take a look at two top-ranked stocks to consider buying that are able to navigate through the current market environment and current economic environment, and certainly look worth considering at the moment. And the first stock we're going to look at is Target, which trades in the ticker TGT. The company posted strong fourth quarter fiscal 2021 results in early March, and it went on to just really flex its financial firepower amid rising prices and supply chain setbacks. Consumers have continued to flock to Target even as pandemic restrictions end, So they're willing to now go back into stores and still spend as much money as they were before. And obviously, it's one-stop shop offerings and e-commerce options are doing really well. So in 2020, amid the height of the pandemic, the company's revenue surged 20%, which is insane for a company of its size. So it went from 78 billion to 94 billion. And then its 2021 revenue, it followed that up with another 13% growth this past year, all the way up to 106 billion, with its comparable sales up 13%, which came on top of comparable sales of 19% in 2020. So it's just massive growth. And then you saw their comparable traffic come back in a big way last year in 2021 as more shoppers returned to the actual physical stores, with comparable traffic up 13 or about 12.5%. We should also note that all 5 of its core merchandise categories delivered double-digit comps growth in 2021. And its digital sales channels continue to provide strength along with its same-day offerings that include in-store pickup, its drive-up segment, and its Instacart-style shipped unit. And then along with its new age shopping push, the company continuing to focus, and Wall Street's definitely appreciating this, certainly for their margins as well, continuing to focus heavily on its own in-house brands. And this is really for everything across their entire scope of their store, from fashion and furniture and food and beyond. This, among other internal strengths, has helped its operating income margin come in at 8.4% last year, which was up 140 basis points or 1.4% compared to 2020. And then on top of that, its strong top line growth, along with its impressive business model, has helped it post adjusted earnings growth of 44% last year as well. So it's various, as we mentioned, those various store brands are really helping. And we should note that Target's slate of all those various in-house brands have helped it separate from rivals such as Walmart and Costco in terms of growth within some key demographics as well. And despite all of those global economic setbacks and rising costs, Target is really even committed to spending on improvements in 2022, which Wall Street was really necessarily should be maybe more impressed with than they are. But the stock went on such a big run. We'll get that in a bit, though. But in 2022, the company is focused on investing in its stores while also growing its digital sales, which account for around 19% of total sales for digital in 2021, up from about 8.8% in 2019. So we can see that the pandemic certainly did shift some shopping habits, and Target was really well prepared for that. So the company is currently doing most of its e-commerce sales from its direct store inventory, where workers are packing up their orders for home delivery from those stores. And then, so this year, the company's trying to spend more on building out larger, what they're calling like sortation centers. So basically just big warehouses like Amazon would have to do those delivery orders from bigger hubs that aren't actually at the store. So they're going to spend some money on that. And then they're going to spend some money on the ad side as well, their internal media operations, to probably maybe get a little bit more of that booming ad market that Amazon and Walmart are trying to get in on as well. So looking ahead to 2022, we're calling for another 3.5% top line growth all the way up to about 110 billion. And then we're calling for another 4.5% growth in 2023, all the way up to about 115 billion. And then we're calling for 7% growth on the bottom line, and then another 9% growth in 2023, on top of back-to-back years of massive expansion. And the top line growth really is in line with what they were doing before the pandemic, when they did 3.6 and 3.5% growth in 2019 and 2018. So it's really impressive to see the company being able to do this kind of sales growth on top of these back-to-back blowout years of growth during the height of the pandemic, and then 2021 as well. So the company's also seen its earnings estimates trend heavily upwards since its last report, to help it land a Zacks rank number one strong buy at the moment. And the company has also posted a long history of bottom line beats, including a 21% average in the last 4 quarters. And the company this past summer flexed its financial stability and confidence as well when it raised its dividend by 32%, with that next payment of 90 cents per share payable on June 10th. And that's to shareholders of record as of the close of business on May 18th. And its current dividend yield is sitting at 1.71%, so about 1.7% at the moment. That tops the S&P 500's average. Walmart's, so its big rival Walmart, is sitting at about 1.5% at the moment, and its industry's average is at 0.92%. So its 1.7% dividend yield is pretty impressive. And then in terms of its performance, Target shares have climbed roughly 300% in the last 5 years. This crushes Walmart's 120%, Costco's 240%, and even tops Amazon over the last 5 years, which is up about 270%. So up 300% over the last 5 years. This includes an 120% climb in the last 2 years. But the last 12 months, obviously things have been much more different after those massive runs have caused most of those stocks to slow down. Target's essentially sideways over the last year. It's up about 4% in the past 12 months, and it's currently trading about 20% below its record highs at around $213 per share. So around where it was trading last May. So this is where we're getting into some enticing levels possibly to get in on Target if you're a longer term investor. And then in terms of its valuation, the stock is trading at year-long lows and at 14.3 times forward 12-month earnings, which is close to its initial COVID sell-off lows and beneath its 5-year median. And it's trading 40% discount to its own highs over the last several years and over the last 5 years as well. So it's now trading at a really solid valuation, and it's trading at a discount compared to its broader industry, despite its impressive outperformance of the last 5 years. And then in terms of brokerage recommendations, Wall Street's still pretty high on the stock. 13 of the 17 brokerage recommendations that Zacks has are strong buys with nothing below a hold. So yeah, if you're a longer term investor and you want to add a strong retail player that's proven that it has a successful business model and it's willing to adapt to do anything going forward, Target might be certainly worth considering at this current price and its current valuation levels, especially when you consider its dividend payment and its ability to sustain its margins despite all of the ongoing supply chain setbacks and all of that. And now we're going to move on to another stock that's in the broader retail apparel space that Target lives in. And that is a company, though, that operates much more behind the scenes. And some people might not even know they own a bunch of stuff that's currently in their closet that's made by this company. And that's Gildan Activewear, which trades on the ticker GIL. Gildan is a clothing company that, as I alluded to, many people might not even know they own. The company is essentially a wholesaler of everyday basic apparel. They obviously sell some themselves as well. They're often branded, though, by some other entity. So if you were to look in your closet, say right now, maybe a vacation destination T-shirt or a company polo or something is made by Gildan. The company's portfolio includes its namesake brand as well as American Apparel, Comfort Colors, and some other brands. And its products feature everything from sweatshirts and fleeces to T-shirts and tanks and socks and activewear, underwear. Basically, they're trying to make everything that's a staple in your wardrobe. So the basics of your wardrobe. The company operates, as I mentioned, kind of in the background, and it's definitely less susceptible to the traditionally quickly changing fashion world where brands can go from kind of cool to out of style, sometimes seemingly overnight. Its customers include screen printers, wholesale distributors, traditional and e-commerce retailers, and then what it calls global lifestyle brand companies. So yeah, lots of they're making the basic things that other people put their logos on, or say they put on Cancun, Mexico or something if you're on a trip. Lots of things. So I encourage you, if you don't know, you might actually own more Gildan things than you can imagine. The company's obviously ability to operate in the background has helped it for the long haul and could be going forward. So the pandemic, though, did hit the company pretty hard, given that a lot of its business is that travel related, also business, apparel, stuff like that. So it did get hit hard last year. Its revenue was down, or during the height of the pandemic. So its revenue was down 30%, but it bounced back in a big way in 2021 with its revenue up 48% to $2.9 billion, which surpassed that pre-COVID total. So that's a great sign to see. The firm also swung from an adjusted loss of 18 cents per share all the way up to $2.72 per share. And the company beat our Q4 earnings estimate by 31% back in February, having now beaten our EPS projections by an average of about 70% in the trailing 4 quarters. The company then saw analysts quickly update their FY 2022 and FY 2023 earnings estimates since that last report to help it also land a Zacks ranked number 1 strong buy at the moment alongside Target. So looking ahead, Zacks estimates are calling for its 2022 revenue to climb another 9%, and it's for adjusted earnings to climb 33% higher, with then another 7% higher sales in 2023 and 13% larger earnings. So impressive growth both this year and next in terms of the top and bottom line. We should also note that back in August, the company reinstated its stock buyback program, and its strong free cash flow helped it reduce its debt load amid the comeback. The firm's dividend yield currently sits at about 1.79%, so about 1.8% at the moment, to top the S&P 500 and some of its peers. Plus, the textile apparel space that it's part of is in the top 30% of over 250 Zacks industries at the moment. And Wall Street is still really high on the stock, with 7 of the 9 brokerage recommendations that we have coming in at strong buys or buys. In terms of its stock price performance, its shares are up about 175% in the last 2 years. This is versus industry's 64% climb and the S&P 500's 75% run. And if we look over the last 10 years, the stock's up also about 175% in the last decade. It would have been on a far better run had it not been for some sideways movement for several years. And then obviously the pandemic, it all came crumbling down along with most of the market. But then since then, it's up about 175%, as we mentioned, over the last 2 years. So despite that climb in the last 2 years and trading relatively near its highs, the stock is trading at 12.6 times forward 12-month earnings, which is 42% below its highs, and it's also sitting below its 10-year median at the moment. So yeah, at 12.3 or 12.6 times forward 12-month earnings, it's trading essentially below where it's been for most of the past decade, besides for those COVID lows and the occasional dip. And it's trading 65% below its highs, which it hit obviously during the initial pandemic comeback. So it's also trading at a discount to the broader textile and apparel space, which trades at about 13.9 times forward 12-month earnings. The company's also heavily invested in its own supply chains and focused on sustainability and stability, so that should help it in the long run as well. And they've spent some of the pandemic improving its supply chains and adding to that supply chain. So that's a good thing, especially when you hear about all the setbacks. So they own a lot of the stages in their production, which is a great sign for the company. And we saw the stock actually pop about 3.7% on Monday. The last time I looked, it's trading at around $38 per share, which puts it about 12% below its records and at nearly 20% below its current Zacks consensus price target, which is sitting at $45.18 per share. So certainly worth considering Gildan as a longer-term play, and then obviously Target as well. Both of these stocks pay dividend, have long-term growth outlooks with stable business models that certainly aren't going out of style anytime soon. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.